All right, for more on what the bond breakout could mean for stocks, let's go off the charts with Jason Hunter, head of fixed income over at JPMorgan Chase. Jason, welcome to the show. Thank you for joining us. And we started off our conversation here on the desk talking specifically about that 10-year yield. So what do you see going on here?
Yeah, so we'll start with our 10-year note view and then go on to equities and say what that means for that. Really what it comes down to, our view on 10-year note yields is evolving ever since the trade headlines hit. If we look at the chart and just take a step back for a minute, as we got into late March, we started to get a lot of technical signaling that was very similar to what we saw in the summertime of 2016 as global PMIs bottomed, global bond yields bottomed with that and tracked that higher through the summertime. The same systematic signaling that fired then started to fire in late March of this year. And that also came hand in hand with first quarter performance in semiconductors that were really, really strong. Something we focused on heavily. Year-on-year performance of the semiconductor index does a pretty good job in forecasting potential turns in global PMI data. So the cross-market dynamic and the technical signaling all fit and called for a move to higher global yields as we move through the summertime. You can quickly see that semis are one of the most quick to react on trade headlines. So this is very much a trade story from the middle of last year when things started to go south, as things started to turn and bottom in the fourth quarter of last year when the trade story started to flip in the other direction. So naturally, this is very much in flux. And unfortunately, this is going to be probably a headline-driven story. There's a limit for what we can get with actual technical signaling. Going back to the yield chart, we're now approaching those same yield levels again, 230, 235, the same levels that contained the rally back in March, where we got that signaling. As the markets traded sideways after the rally that triggered that, things have had time to normalize. So to generate the same type of overbought signaling that would generate the same type of systematic sell signals again, you probably need something closer to 220, 2.25 by current readings. That can change as time progresses. But from what we can see right now, that's where we think the market would need to get to in order to get that level of sell setup. And for the time being, as long as the market's richer than really this 241 area, that little pattern that we broke out of, and then the 252 gap, that was the Sunday night headline gap that started this whole risk-off move. As long as we're richer than that, for the time being, the market's got a bullish bias on rates until proven otherwise. So what does that mean for equities? As we look at the S&P chart, we've seen a similar risk-off move unfold. What we see now for equities, though, is a market that's holding key support that we've highlighted for the past 2 weeks ever since those headlines hit. And that's really the 2,800, 2,840 area. That's been a big inflection for the market for a while, even going back to last year. And as long as that holds, you're not triggering a lot of negative momentum signaling. That if you look underneath the 2,800 area of the 100-day moving average, 200-day moving average, the one-year volume-weighted average price for a number of the larger ETFs that track the S&P 500 and other, 3-month, 6-month, 12-month momentum measures all sit just below that in the 2,700s. So in a certain sense, there's a level of hope here because, again, this is headline-driven that you don't want to see the market get down there and test that, where it can trigger a technical event that hasn't yet happened on the chart. For the time being, that 2,800 area, that's our line in the sand. Below that, the conviction level that we see a better test of this 2,950, 3,000, that right now is tentative for the time being.
All right, so Jason, you're the head of fixed income. You do technical analysis, so you are the perfect guy to ask. When you marry those two charts, I mean, is the bond market sending us a warning sign, or is it simply confirming that, we should be sort of at this middling level on the S&P 500?
I think it's more of a confirmation. In fact, if you look at the bond market, like we said, it tends to track global PMI, not lead it. If you look at things like semiconductors, industrial metals, we've done a number of pieces on this with the other groups in the firm. They tend to be the leading indicators here, not bonds.
All right, Jason, great to have you. Thanks for coming by. Jason Hunter of JPMorgan. What do you think, Tim?
Well, yeah, I mean, the correlations are really important. He talks about semis. I mean, think about, and we've talked about what was the last time we had kind of this growth scare. Dan talked about 2015 into 2016. We bottomed in the S&P before we started to feel like actually we're not going to get a recession in 2016. Guess where semis were back then? The SMH, which now is close to 109, 110, was at 52 in the first quarter of 2016. So think about what's run. Think about equities and think about what could happen if we get a place where people are very concerned about. It's been one thing to speculate about not being at 2%, let alone 3.2 on GDP. You start to really have a recessionary fear. Equities have a lot of room down.
Yeah, we already see Fed funds futures saying a 53% chance of a rate cut in September.
Right. So here's the scary thing. To your point, Tim, I mean, we went down 20% in a straight line in Q4 of 2018 because of those.
Someone just called me to
fears.
tell me there's a recession coming.
Understood.
Sorry, just kidding. Not funny.
But I guess the real issue is with rates where they are right now, if we do have that growth fear, where do we go to QE4? You know, we literally had that 2015 volatility because we had just ended 3 rounds of QE where the Fed had just bought $4.5 trillion worth of bonds just to get us to where we were then. Now, here we are, and we're already talking with Fed funds at 2.25 about going back to zero and instituting QE again? I mean, so that's the danger here, is that if you think 20% was a garden variety correction in a secular bull market, what's going to happen if everything goes haywire? We have another crash on our hands. I'm not saying that we're going to crash.
What does crash mean?
Well, a crash means what happened in 2000 and 2003. The S&P lost 55% of its value. And then in 2007 to 2009, it lost 55% of its value. That's what a crash is.
Conditions are